day, everyone. Thank you for joining us once again here at Seaford and Brew for our economic briefing. For this briefing, we're going to go over the advanced release of the third quarter GDP. We knew it was going to come out really strong, and in fact, that is what we saw coming up 33.1% in terms of total growth for the quarter. Significant growth rates, specifically coming off of that 31.4% decline in GDP for the second quarter. How does this compare to history? When we look back over the course of time, going back to 1879, we can see that the GDP growth rate for the quarter only exceeded 30% 3 times back during its highest growth at 40.5% in the fourth quarter of 1879. And then we saw it above that 30% mark during the late teens, 1919, and also during World War II, where we saw these numbers in the growth rate for GDP up over 30%. But 33.1%, very strong for the third quarter of 2020. Looking at the contributions of the different sectors, if you recall the 4 main sectors: consumer, investment, government, and net exports. Consumer number we knew was going to be strong, came out contributing 25.27 percentage points to the overall growth rate. That was led because it had an increase in consumer spending of 40.7%. Tremendous increase coming off of the shutdown of the economy during that second quarter. The investment portion we can see contributing 11.58 percentage points, very strong as well. More than half of that, though, was made up by inventory, by adding inventories. In fact, 662 basis points is the contribution from inventories alone. Very strong number. We will likely not see that same number when we look at the fourth quarter GDP growth. But when we look at the components there, the other components in investments, residential fixed investments up 59.3%, and non-residential or business investments up 20.3%, both very strong numbers. Look at the government. Government spending actually declined in the third quarter, pulling off about 68 percentage or basis points off of total GDP growth. State spending down 3.3% and federal spending down 6.9%. Then we look at the exports, the net exports, taking off about 3 percentage points off of the overall growth rate. And that was because we had an increase in exports of about 59.7%, and that was offset by a tremendous increase in imports of 51%. And that's just the dynamics of shutting everything down and then starting to reopening up our borders to that trade coming in. So we have those odd dynamics. We have a lot of noise right now in these numbers, and we'll have to see once we get into the fourth quarter if we continue to see these improvements move forward. But overall, 33.1% in that growth rate. When we saw advanced retail sales number very strong, up surpassing where we were pre-pandemic. So we had a full recovery when we look at this advanced retail sales, that contributing to that tremendous increase in the overall level of growth in that consumer segment. Then we saw the 1 to 4 family new home sales skyrocket in here, up over 1 million for August, and then we came back down slightly for September, but still very strong in terms of residential real estate and new homes and in existing homes, continue to make that upward trajectory, breaching where we were pre-pandemic levels. The issue that we're having right now in that residential is the fact that supply is not there. Supply and demand is off. We have a lot of demand and we're having a lack of supply. In fact, now we're down to about a 3-month supply, and that is causing those overall values to increase. If you recall, back in September, the Fed gave us their estimate in terms of what they saw GDP growing at for 2020, and we can see they had GDP at a projected growth for 2020 at down 3.7%, whereas in 21 they had a growth rate of 4%, in 22 a growth rate of 3%, and in 23 a growth rate of 2.5%. So how does this overall level of that 33.1% work in here? We see when we build in the most recent growth rate in GDP of 33.1%, that would give us about a negative 1% contraction in GDP in the fourth quarter in order to get us down to that negative 3.7% growth rate overall that the Fed is projecting for 2020. That being said, that is unlikely to see another decline like that unless we begin to, and we continue to see the continuation of the spread of COVID and the number of cases increasing throughout the United States, and we start to see some states pull back on their opening efforts and begin to shut down certain economies. So that would lead to another negative growth rate in GDP for the fourth quarter. However, that in my mind is unlikely when we're looking at that. But overall, the Fed continues to build their balance sheet up over $7 trillion at this point. They continue to buy $120 billion in securities every month, $80 billion in treasuries, and $40 billion in mortgage-backed products. So we continue to see them bolster their balance sheet in an effort to keep that long rate down. And in fact, we still have 10-year treasuries under 1%. In fact, they're still under 80 basis points at this time. We got up a little bit higher than 80 basis points, and then we pulled back down below. And it would not be surprising if we continue with a 10-year treasury below 1% for the foreseeable future. That's going out, measured most likely in years. But when we look at the overall inflation number within this report, we can see that the price index for the PCE core, that's excluding food and energy, is up 3.5% in terms of the overall inflation number for the third quarter, up from where it was in the second quarter at negative 0.8, and in the first quarter at 1.6. Now these are quarterly numbers, quarter-to-quarter changes. When we look at the annual changes in the core PCE, we can see that is up 1.4%, whereas last quarter, in the second quarter, it was up 1%, in the first quarter, 1.8%. So we do see that inflation creep in here, and that's something we will keep an eye on. As you know, the Fed is looking at that 2% level in terms of determining when they're going to adjust their tightening, and we're not there. While we're at 3.5 for the quarter, they want to now look at an average over time, and that coupled with the unemployment rate and getting that back down to full unemployment, we're likely going to see that Fed funds rate down where it is near zero for the foreseeable future. When we look at the personal income actually declined in the third quarter. We can see it go from 20.4 trillion down to 19.8 trillion. That decline was primarily driven by the transfer receipts. We can see the personal current transfer receipts. These are the social programs, the funds that people get, unemployment and social services. That fell from 5.6 trillion down to 4.4 trillion. That was a big push in moving that overall personal income number down. We also had a very significant savings rate again. While it came off of its high of where it was in the second quarter at 25.7%, it had moved down to 15.8%, still at a very high level compared to double where we were over the past several years. And we've seen that savings rate increase. We've seen that in the overall level of deposits in commercial banks. As you can see, during the pandemic time period, we saw the overall level deposits skyrocketing here. In fact, now we're up over $15 trillion for deposits in commercial institutions. And if we were to look at this pre-pandemic, we were just over 13 trillion. So we added a bunch of money into the deposits because of the stimulus checks that people received, as well as those PPP loan proceeds flowing into those deposit accounts. We should expect to see some of that money flow out. However, if we were to get another stimulus bill that included checks to individuals, you're going to see the deposits increase by another $1 trillion potentially during that from that stimulus. So that could be another significant inflow of cash into these deposit accounts. So overall, when we look at the economy for the third quarter, very strong, growing at that 33.1%. The inflation number in that core PCE quarter over quarter at 3.5%, and that savings rate at a substantial above 15%, showing that we do have money in the coffers for when everything opens up fully and where the virus is behind us. We will be able to get back on track with this economy and start to grow rapidly. And that's where we are going to end today. Next week, we will look at the performance of the Community Bank Benchmark Group. Have a great day, everyone.